Will the housing market crash? A housing bubble burst isn't imminent, but here are the factors to keep an eye on. Any period of economic uncertainty can make a major financial decision, like buying a house, more stressful. Even times of economic confidence can seem like the perfect time for the bottom to fall out, and you don't want your home to be collateral damage. While the housing market on a national scale has seen prices decline since mid-2022 amid high interest rates, experts are noting that a sudden and abrupt housing market crash is unlikely, based on current market conditions. Housing demand, housing supply, mortgage interest rates and unemployment all play a role in how the real estate market fares, and currently they indicate a period of decline in some markets and growth in others, but a decline in transactions overall, and certainly not significant decline as seen in the housing market crash of 2008-2009. Are we in a housing bubble? In economics, a bubble is defined as a period of rapid market value growth of an asset, in this case, homes. Considering the fast pace of the housing market that has lasted roughly the length of the COVID-19 pandemic, rapid market value growth accurately describes the housing market up until about midway through 2022. Home price growth was in the double digits year-over-year every month from August 2020 through mid-July 2022, based on home sale price data from Redfin. Signs of a growing housing bubble may be waning now, however. Month-over-month prices have declined since summer 2022. And while home prices were up by 1.5% year-over-year in January, the median home price, at $353,000, fell year-over-year by 1% between February 6 and March 5, according to Redfin. We're looking at home prices right now and think they're a bit overextended, still, of what they should be, given mortgage interest rates, says Mike Reynolds, Vice President of Investment Strategy at Glenmead, a wealth management firm headquartered in Philadelphia. While mortgage rates are technically independent of the federal funds target rate set by the Federal Reserve, they often increase or decrease as a result of the Fed's actions. The federal funds target rate has been raised repeatedly in the last year in a marked effort to curb inflation. The average 30-year, fixed-rate mortgage interest rate reached more than 7% in October and November 2022, but dropped close to 6% in January. The average interest rate is showing some volatility now, and as of March 9, the average rate is 6.73%, according to Freddie Mac. Rates in January encouraged some buyers to come back to the market. Zillow's January 2023 market report shows that newly pending listings in January were only down 20% from January 2022, an improvement compared with November, when newly pending listings were down 38% year-over-year. The more volatile mortgage interest rates may see some buyers backing off the market again if they continue upward. Current homeowners still don't appear eager to sell, however. The supply of houses on the market, which has been a major cause of fast rising home prices even before the pandemic, remains low as homebuilders back off plans for major development. Homeowners are choosing to stay in their current homes rather than take on a higher mortgage interest rate. Tucker points out that volatility among mortgage interest rates could lead to some back and forth with homebuyers. The uptick in rates in the second half of February and early March could result in buyers once again backing away from house hunting. A lack of demand will ultimately lead to declining year-over-year home prices, but that doesn't necessarily mean the housing bubble will burst. Reynolds speculates that a return to equilibrium, where homes are priced accurately to buyer affordability, is more in line with what he expects. It's possible a little bit of air gets let out of this bubble, but an outright burst is unlikely this time around, Reynolds says. The decrease in the number of home sales since interest rates initially rose is stark. From February 6 through March 5, there were roughly 22% fewer homes sold compared to the same time last year, according to Redfin data. But the ability for homeowners now to wait out economic uncertainty and climbing interest rates may be what keeps any drop in home prices from becoming more concerning. Even with the year-over-year increase in pending deals, based on Zillow data, Tucker notes that existing homeowners don't appear willing to sell their homes yet. Markets that experienced faster home price growth in recent years are more likely to see bigger dips as home prices correct to fit with long-term demand, says Jared Kessler, founder and CEO of EasyKnock, a company that provides an alternative to home equity loans. He expects to see the markets where prices shot up high and faster than others, such as Austin, Texas, Nashville, Tennessee, Miami, and Phoenix, as places more likely to see housing prices decline 10% or more.